Policymaking power. Although the European Union has made only rudimentary policy in many areas, such as defense and social policy, it clearly sets strong policies in other areas that previously were controlled by the individual countries. Three areas of active policymaking are creating and maintaining a single internal market. By and large, the EU has removed most of the old tariffs and other barriers to trade among its members. For example, trucking goods across national borders is much easier today than it was before the EU was created. Also, most professional licenses, such as those for doctors and beauticians, are accepted in all member states. An exception is that lawyers' licenses are only good in the country that issues them. So policy differences still exist among the nations, but the single market has greatly affected both European governments and their citizens. More options are available to shoppers and consumers now that goods are freely transported across national borders. Union of monetary policy. The EU has made remarkable strides in its ability to set European monetary policy, the control of the money supply. Today, the euro has replaced many of the old national currencies, which are well on their way to being phased out. Also, the power to set basic interest rates and other fiscal policies is being passed from national banks and governments to the European Monetary Union and its new central bank. Today, in most of the member countries, the euro is accepted as common currency both in banking and for everyday business transactions. Most of the newer members are in the process of changing their currencies to the euro. But two exceptions to the rule are Britain and Sweden, which still refuse to give up their national currencies in favor of a common European currency. The economic recession that began in late 2007 was a challenge for the viability of the euro, but so far there have been no strong movements to abandon it. For most of the newer members, the recession made conversion to the euro even more important, since their national currencies are generally not as stable as the euro. The recession also put pressure on the economic coordination capabilities of the EU. Most of the stimulus money generated in Europe after the worldwide monetary crisis in September of 2008 came from individual member states. In November 2008, the European Commission set out proposals for a Europe-wide fiscal stimulus, but it had no authority to compel member states to contribute, so it had to serve mainly a coordinating role. What followed was disagreement among member states over how or whether to use the stimulus money, illustrating the reluctance that governments have in ceding control over their own revenues. Common agricultural policy. Implementation of policy in this area has generally been less successful than others, but the EU has put in place significant new agricultural programs with almost half of the organization's budgets going to this policy. One goal has been to modernize inefficient farms so that they might compete in the common market. In order to meet this goal, the EU established farm subsidies, guarantees of selling goods at high prices. The subsidies have proved very expensive and have yet to improve farm efficiency in any measurable way. Recent reforms of the system have transferred subsidies away from price supports for specific crops and toward direct payments to farmers. A growing chunk of the money goes to rural development projects, not farming as such. By the late 1990s, the European Union began to lay the groundwork for future policies in these areas. Common defense. European integration began with economic policy, so EU defense policy is much less well developed than those for trade and common currency. However, the Maastricht Treaty made foreign and defense policy one of the three pillars of the EU, so some defense policies have been put in place. In 1999, the European Council placed crisis management tasks at the core of the development of common security and defense of EU members. Crises were defined as humanitarian, rescue, and peacemaking tasks. The Council set as a goal that the EU should be able to deploy up to 60,000 troops within 60 days that could be sustained for at least 1 year. The agreement left troop commitment and deployment up to the member states, and as a result, did not create a European army. Justice and Home Affairs. The 1997 Treaty of Amsterdam set major policy initiatives for judicial affairs. The aim was to establish within a few years the free movement of European Union citizens and non-EU nationals throughout the Union. Free movement has involved setting policy regarding visas, asylum, and immigration. Additionally, the Treaty of Amsterdam helped to define cooperation among national police forces and judicial authorities in combating crime. Although member nations may support an EU structure in areas of justice, freedom, and security, they are not compelled to participate. In these areas, Britain, Ireland, and Denmark restrict their participation to only a few select provisions. Terrorism. The EU has become very concerned about terrorism since the September 11, 2001 attacks on the World Trade Towers and the Pentagon in the United States. More recent bombings have rocked transportation systems in Spain, 2004, and Britain, 2005, reminding Europeans that terrorists have almost certainly taken advantage of the increasing ease of travel across country borders created by integration of nations. Beginning in April 2004, United States and European Union officials held a series of policy dialogues on border and transportation security that focus on better addressing common security concerns and identifying areas where US-EU cooperation and coordination might be enhanced. The European Constitution and the Lisbon Treaty. On October 29, 2004, European heads of government signed a treaty establishing a European Constitution. The intention of the Constitution was to replace the overlapping sets of treaties that govern member states' interactions, and to streamline decision-making as the organization had grown to 27 states by then. The Constitution went through the process of ratification by member states, and was scheduled to go into effect on November 1, 2006. However, in mid-2005, French and Dutch voters rejected the treaty in separate referenda, prompting other countries, including Britain, to postpone their ratification procedures. In December 2007, in an effort to salvage the goals of the Constitution, the heads of state or government of the then 27 member states signed the Lisbon Treaty, a document that attempted to consolidate previous treaties that were still in force. Some important provisions of the treaty are a strengthening role for the European Parliament. The treaty gives the Parliament new powers over EU legislation that places it on equal footing with the European Council, gaining new rights in farm subsidy policies, border controls, asylum, and integration. Members of the European Parliament, MEPs, also have more say over the EU budget, bowing to national government in only a handful of areas like tax and foreign policy. A greater involvement of national parliaments. National parliaments have more opportunities to be involved in the work of the EU, particularly through a new mechanism that ensures that the Union only acts where results can be better achieved at EU level. The aim is to enhance democracy and increase legitimacy in the functioning of the Union. Clarification of the relationship between member states and the EU. The treaty created a system called categorization of competencies that more clearly delineates the realms of responsibility of the EU in contrast to the initiatives best left up to the national governments. Withdrawal from the Union. For the first time, the possibility for member states to withdraw from the EU was recognized. The creation of a permanent president of the EU. Before the treaty was signed, the presidency of the European Council rotated every 6 months, and it was usually filled by the top executive of one of the member states, and so the position has a limited amount of power. The Lisbon Treaty made that position permanent and full-time, and provided for a 2.5-year term of office, renewable once. Introduction of a Charter of Fundamental Rights. The Charter promotes individual civil, political, economic, and social rights for European citizens. The negative reactions in France and the Netherlands to the European Constitution reflected a growing resistance to integration, especially as the European Union membership continues to grow. Many fear that the power shift from national to supranational institutions will result in a democratic deficit, the loss of direct control of political decisions by the people. The European Parliament is the only directly elected body, and it is the weakest of the major EU bodies. The EU, then, is perceived by many as lacking accountability to citizens and member states. The provisions of the Lisbon Treaty were meant to address these concerns, but it too was rejected by a popular referendum, this time in Ireland in June 2008. However, the treaty was eventually ratified by all member states, and it went into effect in December 2009. The post-World War II visionaries who first conceived of a European Union saw not only an economically united Europe, but one with close political cooperation as well. So far, the European Union has shown little movement toward political integration, although the Maastricht Treaty of 1991 did include it within the three pillars, or spheres of authority. More cooperation in foreign and national security policy is still on the EU's agenda, but economic integration remains the focus today. Economic issues. The European Union has long been defined by a tension between economic liberalism that favors open, free markets and an economic nationalism that seeks to protect national economic interests from the uncertainty of free markets. The older, more established EU members tend to reflect the latter policy orientation, while the newer, less economically stable members often favor economic liberalism. Supranationalism encourages economic integration, but the proper balance with national interests is often a controversial topic. The sovereign debt crisis that began with the near collapse of the Greek economy in 2010 illustrates this tough issue, and the arguments that have erupted since then strike at the heart of this old tension. Austerity programs. In reaction to the sovereign debt crisis, many European countries put austerity programs in place. These programs were designed to reduce budget deficits by cuts in spending and tax increases, and they quickly became controversial as unemployment rates increased and GDPs stagnated. Countries that put austerity programs in place include Germany, the Czech Republic, Britain, Italy, Greece, Ireland, Portugal, Romania, and Spain. In many places, the programs sparked protest, especially as government welfare programs were cut. Austerity programs became quite controversial as economists debated their effectiveness in solving the debt crisis. The Greek crisis. It was no surprise that the debt crisis began in Greece, which failed to join the euro area when it was set up in 1999 because it did not meet the economic or fiscal criteria for membership. Revisions to its budget figures showed that it probably shouldn't have been allowed in when it did join in 2001. After the international banking crisis of 2008, concern for sovereign debts, debts of individual EU countries, increased, especially for those with high debt-to-GNP ratios. Attention focused first on Greece, and in May 2010, the Eurozone countries and International Monetary Fund agreed to a large loan to Greece, conditional on the implementation of harsh austerity measures. The Greek bailout was followed by a rescue package for Ireland in November and another for Portugal in May 2011. During the summer of 2015, Greece once again could not meet its credit obligations, and the Greek Prime Minister, Alexis Tsipras, staged a showdown with Greece's creditors. The other nations that used the euro, the European Central Bank, and the International Monetary Fund. Mr. Tsipras balked at further austerity measures and sponsored a referendum in which Greek voters strongly supported him. However, the Prime Minister finally gave in and accepted a new package of budget cuts, tax increases, and other economic policy changes in return for an additional 86 billion euros, or $97.2 billion, in aid necessary to reopen Greece's banks and avert default on its loans. Bailouts and economic restructuring. These bailouts have been controversial, with some arguing that they are essential for keeping the economic health of the entire EU region, but others complaining that it is unfair to expect taxpayers in healthier countries to pay for the economic woes of less stable members. The bailouts are particularly unpopular in Germany, where one poll showed that a majority of the public thinks that the rescue of Greece was a mistake. As talk of a second bailout for Greece materialized in mid-2011, there was strong resistance in Germany to further assistance to the Greek economy. At summit meetings in 2011, European political leaders discussed the possibility of restructuring the economies of Greece, Ireland, and Portugal. Economic structural adjustment would mean that at least part of the debt would be forgiven. Supporters of restructuring claim that it is the only way to allow the weakened countries to recover. Critics believe that restructuring makes the stronger countries pay for the weaker ones, a process that they claim weakens the entire continent. The crisis seriously questions the economic stability of the euro and the European banking system, and so the solutions that European leaders find will almost certainly influence the future development of the EU. The sovereign debt crisis has impacted the economies of almost all European countries, not just those with the most fragile economies. The countries that adopted the euro were supposed to adhere to strict spending standards to prevent their debt from getting too big. They agreed to a debt target of 60% of their economic output. Some did, but others could finance their deficit spending at relatively low interest rates as long as Europe's economy remained healthy. However, when the financial crisis erupted, the economy shrank and their debts ballooned. Investors began to lose faith in the ability of those countries to repay their debts. In 2012, according to estimates by the New York Times, not even the strongest economies in Europe met the target. Germany's ratio of gross government debt to gross domestic product was 79%. But other countries have had much higher ratios, such as Greece, with a ratio of 153%. Migration issues. Migration has long been an issue for EU member states, but the rising number of refugees seeking asylum in Europe reached a crisis level in 2015. Most were fleeing war-ridden states, especially Syria, Afghanistan, and Eritrea. The crisis drew attention in April 2015 when 5 boats carrying almost 2,000 migrants to Europe sank in the Mediterranean Sea, leaving more than 1,200 people dead. The European Union has struggled to cope with the crisis, with EU member states receiving about 395,000 new asylum applications during the first half of 2015. In September of 2015, EU interior ministers approved a plan to relocate 120,000 asylum seekers over 2 years from Italy, Greece, and Hungary to all other EU countries, except Denmark, Ireland, and Britain. These mandatory migrant quotas quickly became controversial, with the Czech Republic, Hungary, Romania, and Slovakia voting against them. Britain agreed to accept 20,000 migrants over 5 years, but only those coming from states outside Europe. Does the European Union represent the trend toward globalization in the world, or is it a better example of fragmentation? Perhaps the EU is forging the way toward global connections, particularly in terms of trade and economic cooperation. On the other hand, it may be forming a bloc that invites other parts of the world to create blocs of their own, setting the stage for fragmentation and conflict among cultural areas. Only time